Welcome to the Steadyhand Mid-Year Review 2018. I'm Tom Bradley, President of Steadyhand, and with me is my investment partner, Salman Ahmed. Today we're going to give you a quick update on how you're doing, what strategies we're pursuing, and then we'll address a topic that I think is on everyone's mind, global trade. Now, I wanted to start with a personal note because I find this part of the market cycle to be the most difficult. And I'm referring to the fact that we've had 9 years of positive returns, and I believe client expectations are fairly high because of that. Meanwhile, as you're going to hear from Salman, opportunities are more limited to generate returns in the future. And overall, there's a general complacency around risk. So it's a bad combination. And certainly, me personally would prefer it the other way around with low expectations, a great opportunity set, and some fear in the air. But to be clear, we don't know exactly where we are in the market cycle. We never do. Nobody does. But from all the work we do and our managers do, it would suggest that we are, to use the baseball analogy, in the late innings, somewhere after the 7th inning stretch. Why do I say that? Well, first of all, it has been 9 years after all since the financial crisis, and we've had good markets all the way along. But there are many other signposts that are typical of a late cycle situation. First of all, interest rates continue to be very low. They tell us that not all is well with the economy when they're this low. And one of the features of the interest rate market is interesting. The fact that short-term interest rates, call it 3 or 5 years, are very similar to 25 and 30-year interest rates, or what we call a flat yield curve. This would indicate that there is a slowdown in the economy coming. Meanwhile, there's merger activity is booming. We see it in the public markets. There's many takeovers happening, some of them at stupendous prices. And Salman and I have had the opportunity over the last month to meet some people in the private equity world, and we hear the same refrain. Every deal has many bidders at the table, and the prices are going up, are higher than they normally are. All of this is fueled by rising debt. Debt is flowing, and the levels in the economy overall, whether it be personal, corporate, or public, are at record highs. And it's a little surprising the recklessness that's going on in the lending market, given that it was only 10 years ago we had a life-threatening debt crisis that we had to deal with. There are other signposts. Unemployment under 4% in the U.S. is a late cycle phenomena. But you'll notice that I haven't mentioned trade or Trump at this point, and we're going to come back to that at the end. So why does all this matter? Now, certainly, as I've said earlier, none of this allows us to predict where the markets are going in the short term. But it does give us the opportunity to confidently say that medium-term returns will be lower from this point on. So the next 5 years, it'll be very tough to equal what we've done in the last 5 years. So why am I so confident? Well, first of all, yields are very low. So the safe part of your portfolio, we're pretty much assured is going to only earn somewhere between 1% and 3%. On other assets, including stocks, valuations are high. And in general, we've had a really good run of corporate profits, and there's really very little room for improvement from the levels we're at. So our managers, as Salman's going to show you, are finding things to do, but it is going to be a bumpier road going forward. There'll be a few potholes along the way. And to go back to the baseball analogy, we're really going to be grinding it out. We're going to be looking for ways to get on base any way we can. Walks, singles, hit by a pitch. So I'm going to let Salman take you through that grinding we're doing with some specifics on the portfolio.
Thanks, Tom. Our responsibility as portfolio managers is to make adjustment to the Founders Fund as risk and return expectations evolve. And so to withstand some of those bumps Tom has alluded to, the fund holds less in stocks today than it has in the past. Instead of holding 60% in stocks, which is the long-term target of the Founders Fund, we hold 54%. And we also hold more cash, 18% versus 5%. That cash is a byproduct of two things. One, our managers don't see as many opportunities to redeploy cash after they've sold or trimmed a holding. And two, we've made the decision to hold 13% in our money market fund, our savings fund, to moderate volatility and also it gives us the opportunity to take advantage of volatility when stocks and bonds become cheaper. And those decisions have contributed to the Founders Fund returning 5.8% over the last 1 year. You can see here, though, both Canadian and global stocks have produced double-digit returns over that period. So having less in stocks in your portfolio has dampened performance over the last 1 year. But we believe it's still the right decision given our outlook. Since the fund was launched 6 years ago, the Founders Fund has returned 7.7% per year on average after fees. And over that time, there have been periods the fund has held more or less than 60% in stocks, which depends on, and we make those decisions depending on our assessment of future returns. Now, thus far, I've largely talked about decisions we've made on the Founders Fund, but the fund is a fund of funds. So what those underlying funds are doing is just as, and actually more important to your returns. Each one of these funds have been transitioning their portfolios to a more cautious stance as well. Take our income fund, for example. In the past, the manager, Connor Clark and Lunn, has had a large weight in corporate bonds. Just 3 years ago, 64% of the bonds in the fund were issued by companies rather than governments. To compensate for higher risk, these corporate bonds have higher coupons and yields, which helps generate income. Today, the situation is completely reversed. The fund holds more in safer government bonds than it ever has, partly because of their defensive nature. Our stock-oriented funds have been making their own adjustments. They're focusing on companies that have stable cash flows to pay out dividends, and other opportunities they've found tend to be in stocks that are out of favor. They've had some temporary setbacks like an order delay or a negative headline, but are still companies with great long-term prospects. And last, they're staying absolutely focused and trimming their winners or just selling them outright. We believe it's these adjustments, both in the Founders Fund and our underlying funds, that will help in this period of uncertainty. And one of those uncertainties stems from global trade. And it's something that we've spent a lot of time thinking about, and I'll pass it back to Tom to elaborate a little bit more on our thoughts.
Well, indeed, Salman, this is an important issue. It has the potential to slow down economic activity and impact corporate profits. But having said that, it's a complicated and very dynamic issue. For every action, there's a reaction. And of course, there's a whole myriad of variables out there: tariffs, currency, input prices, the competitive position of the different countries, and then under that, the companies. I have to wonder if the worst scenario of all of this isn't already playing out in the fact that we have this uncertainty going on, and decisions in the businesses and in public policy are being made in a vacuum. Salman and I have watched this play out in the UK much longer than we have with NAFTA here in Canada, and we're now seeing decisions made where people are being deployed, plants are being built, and it's not in the UK because people don't know how the UK is going to fit into the world overall. Now, everybody's trying to pick winners and losers in this trade thing, and I've just read a number of pieces this week in the paper, and I think I read that we should buy China, we should sell small caps, park your money in gold and US dollars. We don't think, and it's not just Salman and I, it's our managers, you can do that. It is too complex. We really don't know how the outcomes are and all the different intertwined reactions are going to go. So we really believe we want to be diversified, as we always are, and stick to our strategies that are based on valuation and long-term fundamentals. Now, as much as we don't have a NAFTA bet on in the portfolio that you have does have a bias. And that's because we have very limited exposure to the domestic economy in the Steadyhand portfolios overall. Now, you might say, didn't I see the Founders Fund has 50% in stocks headquartered in Canada? Well, that's true. But if you drill down on those companies and look where they get their revenues and profits, you'll see that most of them are very global in nature. We have limited exposure to the Canadian banks, retailers, and real estate, all of which, of course, would be very dependent on our economy here in Canada. So the consequence of this bias is that if NAFTA goes badly or it gets ripped up, we should weather the storm quite well, knowing that there's some bumps along the way and reactions to short-term news. But if NAFTA goes spectacularly well and we get everything we want from the U.S. government, we won't likely capture all of that upside or all of that excitement in the portfolio. So today you've heard that we're pretty dialed down, and our managers are doing that too, but they're also finding things to do. And despite my lament at the beginning, we will remain disciplined, diligent, and focused on earning you returns over the full market cycle, which includes the good and the bad. And I encourage you to do the same. Stick to your plan. And it's probably a good time in the market cycle, as we've talked about, to just make sure you're not taking undue risk. Some people are maybe getting excited about chasing short-term returns, and we think you want to be right on your plan as far as risk goes. So if you have any questions, don't hesitate to call Salman, myself, or anyone on our client service team. We'd love to talk to you about this. In the meantime, thank you for listening, and have a great summer.